Wall Street is still weighing risks. The U.S. debt trading deal prevents the U.S. from defaulting on its debt. Market participants are trying to draw conclusions from a large deal of macroeconomic data, and market sentiment is confused by comments from Fed's policymakers, strong data on the U.S. labor market, and anticipation of the NONFARM payrolls. The benchmark stock indexes traded in the red yesterday on a pessimistic note. The Dow Jones shed 134 points, or 0.41% intraday. The Nasdaq also lost its optimism and closed 0.63% down. The S&P 500 dropped by 0.61% to close at 4,179 points. The major stock indexes traded mixed in the New York pre-market. The S&P 500 is expected to trade in the corridor between 4,150 and 4,220 points. Wall Street indexes closed lower on Wednesday because the deal on the U.S. debt ceiling was still unsettled. Investors were alarmed by strong data on the labor market, and the stock market came under selling pressure because investors feared that the House of Representatives could not approve the debt ceiling and budget cuts. Nevertheless, most analysts anticipated lawmakers would vote for the bill to avert the prospects of the U.S. defaulting on its debt. U.S. President Joe Biden said that he would sign the bill into law by next Monday. Market sentiment turned sour yesterday in the light of a fresh JOLTS report by the Department of Labor. The number of vacancies in the United States unexpectedly rose in April, thus proving a steady strength of the labor market. In turn, this implies wage growth and inflation acceleration. At the same time, Fed member and the vice chairman candidate Philip Jefferson said that the decision not to raise the funds rate in 2 weeks would give policymakers time to see more economic data before the next policy move. Philadelphia Fed President Patrick Harker also said on Wednesday that he is poised to support skipping the rate hike for now. In addition to these statements, the Federal Deposit Insurance Corporation said on Wednesday that the total volume of bank deposits in the United States shrank by a record 2.5% in the first quarter after the failure of 2 large banks. In this context, the S&P 500 financial sector fell by 1.1%, while the banking sector alone sank by 2%. Shares of advanced auto parts tumbled by 35%, the biggest drop in the S&P 500 after the auto parts retailer cut its full-year guidance. Shares of other auto parts manufacturers fell by 2.7% and 5.6%. Shares of Nvidia shed 5.7% intraday after hitting an all-time high, while Intel posted the biggest gain in the S&P 500, climbing by 4.8%, as the chipmaker said it was on a track to top its second quarter revenue guidance. Intel shares jumped by 14.7%, the biggest 3-day rally in more than 10 years. At the same time, the S&P gained 0.2% over the months. The Dow lost 0.3% and the Nasdaq grew considerably by 5.8%. U.S. stock indexes futures rose on Thursday after the House of Representatives passed a bill to suspend the national debt ceiling, but later pulled back on the data from the labor market. The bill to suspend the $31.4 trillion debt ceiling was passed with a majority support from both Democrats and Republicans and will now go to the Senate, where lawmakers will pass it before a deadline on a Monday when the government runs out of money. Even after the vote in the House, the stock market remained in a tight range as investors focused on economic indicators that will set the tone for the US Federal Reserve and provide more details on the impact of its hawkish monetary tightening on the economy. If the Fed misses a rate hike this month, it's probably because it's just as confused as everyone else by US economic conditions. The rebound in the number of vacancies in the United States in April showed that the labor market has contracted again. Investors were even spooked by the Chicago manufacturing survey because of a sharp contraction in manufacturing activity last month. The private sector employment and data on the wages for May could hardly calm down the market today. The US private sector added 278,000 jobs in May from 291,000 jobs in April, much more than the forecast for 170,000 jobs. Small businesses created 235,000 jobs, medium companies 140,000, whereas large companies reported 106,000 layoffs. Besides, wage growth slowed down. In a separate report, the number of first-time jobless claims increased by 2,000 to 232,000 last week, the biggest growth in a month, though below the consensus of 235,000. In the Beige Book, the Federal Reserve said that the labor market remained resilient in May. However, employers reported difficulty finding personnel with a wide range of skill levels and industries. Apart from the labor market, investors will get to know the manufacturing PMI by the S&P Global and the ISM manufacturing PMI. In the corporate news, Salesforce shares included in the Dow Jones fell by 6.2% in pre-market trading after the company posted its lowest revenue growth in 13 years. Macy's shares plunged by 10.2% and Dollar General shares shed 6.1% as both retailers cut their full-year sales forecasts amid high inflation. Despite the upbeat data on the US labor market, the US dollar index pulled back amid recovery in the euro and the default aversion in the United States. The index slipped to 103.90, having shed 0.33%. The intraday corridor for the index is seen between 103.70 and 104.30. While the US stock market is anticipating the macroeconomic data and the final vote for the debt ceiling deal, the euro is dazzling in the currency market, and the euro has rebounded sharply against the US dollar because the fresh report showed a stunning decline in inflation in the eurozone. The CPI sank to 6.1% in May, following a 7% in April, lower than the expected decrease to 6.3%. The euro pushed the US dollar down, whose index pulled back from the highest level in 2 months. Besides, the greenback was discouraged by lower expectations of another rate hike by the Federal Reserve. Indeed, Fed policymakers signaled a pause in monetary tightening in June because the central bank needs time to evaluate the impact of its hawkish policy on the US economy. According to the Fed Watch tool, markets are now estimating the likelihood that the Fed will raise rates by 25 basis points at its upcoming meeting at about 37%, compared with the 67% probability the day before. It winds on a dollar optimism. Ahead of the official data on the labor market, which is due on Friday, the US dollar index has a fair chance to rebound to the earlier highs. As the greenback is now on the defensive, the Canadian dollar can recover. Having dipped by 0.23%, the USD card pair is now trading at about 1.3540 inside the intraday corridor between 1.3510 and 1.3590. Amid minor weakness in the US dollar and stabilization of oil prices, the loonie gained ground today. Still, oil prices extended their slide in the early New York trade. Brent crude futures slipped by 0.7% to trade at $72.08 a barrel, and WTI futures dipped by 0.3%. The recent economic data from China gave mixed signals of demand in the world's top oil importer. Besides, selling in the oil market was triggered by industry data indicating expansion in the US crude inventories. The crypto market is trading quietly today, mainly lower. Bitcoin shed 0.6% intraday, though clinging to the level of 26,900. Popular altcoins are trading mixed. As for the industry news, on Wednesday, the European Union officially signed into law the crypto asset markets framework. After receiving approval from the Minister of Finance, the bill was signed by the President of the European Parliament. The document will enter into force in 2024, marking the beginning of the regulation of cryptocurrency firms operating in the European Union. In addition, the United Arab Emirates Central Bank announced the introduction of a new guidance regarding anti-money laundering measures for virtual assets, cryptocurrencies, and NFTs. The focus of this guide is to ensure that financial institutions operating in the United Arab Emirates comply with the anti-terrorist financing measures. The new rules will come into effect in June. Returning to the intraday outlook for Bitcoin, the token could trade in a narrow range of 26,800 to 27,200. If the flagship crypto cannot stay above 26,800, then it will go down to 26,600 and $26,200. An alternative scenario looks like growth to $27,200 and $27,600 with the most optimistic forecast. And that's all for today. We keep monitoring the financial market situation and wish you successful trading day ending. Subscribe to our channel and see you online tomorrow.